welcome to the deep dive. Let's jump straight into Citigroup's Q3 2025 earnings. A lot of buzz around the top-line numbers, our mission, to unpack what drove that big beat and what it signals about their strategy going forward.
It certainly was a quarter that needed a bit of unpacking. You look at the initial report, you see EPS of $1.86, but the adjusted figure, that's where the real performance story is.
Yeah, $2.34 adjusted EPS. That definitely turned heads. Analysts were, what, $1.75, maybe $1.90, so a massive beat there, up, what, 48% year-over-year adjusted. And revenues look solid, too, $22.1 billion, up 9%.
Right, and that difference between reported and adjusted, it all comes down to that notable item.
Yeah.
It was a $726 million goodwill impairment charge tied to the Banamex deal. That's about $714 million after tax.
So why do investors kind of look past that impairment charge?
Well, because it's essentially a bookkeeping entry related to their simplification strategy. It's not, an operational loss from the core businesses they intend to keep. Looking at the adjusted number gives you a clearer picture of the underlying health of those 5 core segments.
And CEO Jane Fraser really hammered that point home, didn't she? Talking about relentless execution. The key thing she highlighted was achieving positive operating leverage across the whole firm and in every single one of those 5 core businesses. That's impressive consistency.
It really is. That's the heart of the turnaround narrative they're pushing, and you see it in the returns. Adjusted ROTCE, return on tangible common equity, hit 9.7% for the quarter.
Okay, 9.7%. That's up, what, 270 basis points from last year, getting really close to that 10% mark.
Exactly. Crossing that near 10% threshold is a big signal that the strategy isn't just about shrinking, it's about actually improving profitability.
And the proof seems to be in the pudding, right? Every core business hit record third quarter revenue. Okay, let's dig into those 5, starting with markets. Always a key engine.
Markets revenue jumped 15% year over year, best Q3 ever for them, which is interesting because they flagged low volatility.
Low volatility but record revenue. How does that work? Is that sustainable?
It's a fair question. They attributed it more to strong client activity and maybe some market share gains rather than just pure trading chop. Fixed income was up 12%, especially in rates and currencies. Equities did even better, up 24%. And a really standout number was prime services. Record prime balances up about 44% year over year.
Wow, 44% in prime balances. That's huge.
That's right.
Suggests they're really pulling in those big institutional clients, potentially from competitors. That says something about their platform.
Absolutely. Okay, then banking. This one really surged, up 34% year over year.
34%. What drove that?
Investment banking fees were up 17%. It was broad-based growth, too. DCM up 19%, ECM up 35%, and even advisory was up 8%.
The CEO mentioned something about increased clarity around tariffs and record equity prices driving CEO confidence. Feels like that unlocked a lot of pent-up activity.
That seems to be the read. Less uncertainty coupled with high valuations got deals moving off the back burner.
Okay, moving to services, treasury, and trade solutions, often seen as their steady performer.
And it delivered. Best quarter ever for services, too. Revenue up 7%. This is really the anchor of the firm in many ways. You look at the fee drivers. Cross-border transaction value up 10%, U.S. dollar clearing up 5%, and the scale is just immense. Assets under custody and administration, AUC/AUA, up 13% to nearly $30 trillion.
$30 trillion. It's hard to even wrap your head around that number. Just underlines their role in the global financial plumbing.
Definitely. And they're trying to leverage that institutional strength into wealth. Wealth revenues were up 8%, mostly from Citigold and the private bank.
They've been really pushing asset gathering there. How'd that go?
Record net new investment assets, NNIA actually, $18.6 billion for the quarter. Plus, they announced that new strategic partnership with BlackRock's Citi Portfolio Solutions powered by BlackRock. That's a pretty significant enhancement.
Integrates top-tier asset management right into their offering. And are we seeing signs of that internal plumbing working, connecting the different parts?
We are. They highlighted transferring $4 billion in deposits from the U.S. retail bank, USPB, over to wealth just in this quarter. That shows the interconnectedness they keep talking about.
Right, the internal pipeline. Okay, so that brings us to the 5th segment, U.S. personal banking.
Also a record quarter, revenue up 7%. And what's notable here is this is the 12th straight quarter they've achieved positive operating leverage in USPB.
12 quarters of revenue growing faster than costs in the U.S. consumer space. That takes discipline.
It does. Branded cards saw interest-earning balances grow 5%, and they mentioned the good reception for their new premium card, the Citi Strata Elite. Seems like they're managing growth and quality.
Okay, so strong revenue, good operating leverage. Let's talk risk. Credit quality. Total cost of credit was $2.5 billion. And non-accrual loans were up quite a bit, 70%. What's behind that spike?
Yeah, that 70% number looks startling, but it seems driven by very specific things. Some one-off corporate downgrades, and then in wealth, some residential mortgages hit by the California wildfires.
So not a sign of broad consumer stress setting in.
According to them, no. They emphasize the U.S. cards portfolio is still high quality, 85% of customers with FICO scores over 660, and the actual net credit loss rates are apparently right where they expected them to be. So risk seems contained for now.
That's crucial context. Okay, shifting gears to the bigger picture strategy. The Banamex exit is key. What's the latest?
They reached an agreement to sell a 25% stake in Banamex to Fernando Chico Pardo. This is a concrete step toward the full exit, which is still planned via an IPO for the rest. The deal values that stake at 0.8 times local book value, roughly $2.3 billion based on the numbers at signing.
And the timeline for getting Banamex fully off the books?
Well, this initial sale needs regulatory approval, expected to take maybe 9 to 12 months. That keeps them on track for the bigger goal of full deconsolidation in the second half of 2026. It's a long game.
It really is a contrast, isn't it? This multi-year divestiture versus the internal tech transformation, which seems much faster. What did they say about AI?
Yeah, the internal cleanup is moving quickly. Over 2/3 of their transformation programs are basically at the target state now. And the AI savings are pretty tangible. They said proprietary AI tools were used almost 7 million times just this year so far.
The really striking number was the automated code reviews, wasn't it? Over 1 million.
Yes. And the estimated impact. Saving about 100,000 hours of developer capacity every week.
100,000 hours a week. That's like finding 2,500 extra developers overnight. That's a massive efficiency gain.
It's a huge lever for driving that positive operating leverage we talked about. And they're applying tech externally, too. Mentioned integrating their token services with 247 USD clearing for real-time cross-border payments. So innovation isn't just internal.
Good to see. And all this performance feeds into capital returns, right?
Yeah.
They bought back a lot of stock.
They did. $6.1 billion returned to shareholders in Q3 alone, $5 billion of that through buybacks. Year to date, that's $8.75 billion under their $20 billion program. Shows confidence.
And their capital ratio looks strong.
Very healthy. CET1 ratio at 13.2%, that's a comfortable 110 basis points above the requirement. Plenty of cushion.
Okay, so looking ahead, what did they guide for the rest of 2025 and beyond?
They bumped up the full year 2025 revenue guidance, now expecting it to be higher than $84 billion. And they gave some color on net interest income, NII, excluding the volatile markets part.
Right, the core lending spread. What's the outlook there?
They expect that NII ex markets to be up around 5.5% for the full year. That suggests confidence in loan growth and managing deposit costs. Expenses will tick up a bit higher than they thought before, mainly due to transformation spending, but they're still aiming for an efficiency ratio slightly below 64%, excluding the Banamex charge.
And that medium-term target, the 10-11% ROTCE for 2026, is still the goal.
Still the goal. They reiterated it. This strong Q3 performance certainly helps build credibility that they can actually get there. That's what the market will be watching.
So wrapping it up, a really strong quarter across the board for the core businesses. Clear benefits emerging from tech and AI, and steady progress on the long-term Banamex simplification.
Yeah, and it really highlights that duality, you know? You've got AI delivering these massive, almost instant productivity gains, 100,000 hours a week saved now. But then you have the big strategic prize, fully exiting Banamex, which just takes patience, regulatory hurdles, market timing, that stretches out to late 2026.
It's managing at two different speeds, the speed of silicon versus the speed of global restructuring. So here's something for you to think about. How much can those immediate tech efficiencies really move the needle on the bottom line when you're still navigating these huge multi-year structural shifts?
It's the key tension to watch, and the next big checkpoint for their strategic narrative will be their Investor Day. Keep May 7th, 2026 marked on your calendar for that.
We hope this deep dive gave you a clearer picture of Citigroup's quarter. Until next time.